This is a presentation on master budgets and why they are important to a business. The master budget is a group of financial statements that predicts the finances of a business. It is an important set of budgets that help to plan and set goals for the organization. It also helps to understand and control costs of a business. A master budget integrates all budgets within an organization to give a complete view with all the financial statements of a business combined together. This helps predict the financial health of a business. You may ask, why does a business need a master budget? A master budget is a financial roadmap for a business and helps managers to understand how costs behave and to plan finances. Understanding the finances helps to set goals for the future growth of the business. The master budget helps management to understand estimated inflows and outflows, and therefore allows a manager to better control the actions of the revenues and expenses. The master budget creates a standard for motivating employees and evaluating performance. It encourages communication and coordination and gives management a picture of when expenses need to be limited and helps to predict the future and allows a business to prepare and adjust accordingly. The master budget consists of three components. First are the operational budgets, which include sales, inventory purchases and cost of goods sold, operating expenses, and budgeted income statement. The second component is the capital expenditure budget, and the third component are the financial budgets, which outline cash, the budgeted balance sheet, and the budgeted statement of cash flow. The first budget that must be created is the sales budget. It is the foundation of the master budget. Sales affect expenses and almost all other parts of the master budget. The sales budget shows predicted total sales volumes and quantities and impacts most other components of the master budget. The next budget is the inventory, purchases, and cost of goods sold budget. This budget helps to determine the inventory needed to ensure a good balance of providing enough goods to customers and not having an excess amount of inventory that could turn into a loss if inventory outdates or is not needed. This budget helps to plan for sufficient inventory purchases and determines information for other budgets, such as the cost of goods sold used in the budgeted income statement, the ending inventory used in the budgeted balance statement, and the purchases for the cash budget. The operating expenses budget shows the budgeted fixed and variable expenses. It helps to understand what the unchanging fixed expenses are, along with the expenses that fluctuate with changes known as variable expenses. The sales budget, inventory purchases, and cost of goods sold budget, along with the operating expenses budget, help to create a budgeted income statement. These four budget statements make up the operational component of the master budget. The budgeted income statement is a business report of the earnings and expenses for a given period of time. It looks at the contribution margin and ensures that the margin is large enough to cover fixed expenses to make a profit. The capital expenditure budget is a budget that helps plan for upcoming purchases such as property, equipment, and other long-term assets. The first financial budget is the cash budget. It is a statement showing budgeted cash payments and receipts. This includes collections from customers, cash payments for purchases and operating expenses, along with capital expenditures. The cash budget uses revenues and expenses from operating budget and shows the transition from the beginning cash balance to the desired ending cash balance. The next budget is the budgeted balance sheet. It uses previous budgets to project assets, liabilities, and the equity of stockholders. It checks the accuracy of other budgets and shows the company's strengths and weaknesses. The budgeted statement of cash flows is the next budget and uses information from the cash budget, cash collections and payments, and other financial activity to illustrate the projected cash flow of the business. It projects the anticipated cash flow in and out of the business and predicts where money will come from and where it will go. All the budgets together make up the master budget. It is important to create the budgets in the order given in this presentation. All the budgets are important and build off the information of the other previous budgets to create a picture of the business and its financial health. Managers must have buy-in of the budget and then show employees how budgets can help them achieve better results. It is important to have employees participate in the budgeting process to obtain better employee buy-in. Budgets are the backbone of a business and are needed to understand the operations and finances of a business. It also gives a tool to evaluate performance of not only the business, but also the employees so that plans can be made for ongoing improvement of a company. A master budget is critical to the long-term planning and survival of a business.